Hi, everyone. Welcome to the Timing Research Show for August 10th, 2015. This is actually the 50th weekly show that we've put on. And today we will be talking about the 98th weekly report from Timing Research. If you haven't had a chance to look at this yet, just go to TimingResearch.com/reports, and you can download it there. So I have Dave Landry hosting for me again. I'm going to go ahead and turn it over to him.
Thank you, David Cosmetter, and thanks to Timing Research for having me back once again. Let's go to you first, Jim. Tell us a little bit about for those of us who don't know you, everyone here is a veteran of the show, so welcome back. But Jim, for those of us who don't know you, tell us a little bit about your trading, and tell us a little bit about OptionProfessor.com.
Well, with OptionProfessor.com, I provide the content for them and obviously have for many, many years. And essentially, it's an education firm educating people on the uses and risks of all the different option strategies, and both from the buy and the sell side. Option Professor has DVDs that people get in order to get more educated. I've been doing the options for many, many years. I'm very familiar with the different things going on with the options, and basically we try to look for strategies that are appropriate for the circumstances. In this environment, a lot of the writing strategies have had better success because we're obviously trapped in a range here for 5 months, and if you get the right parameters, you can take advantage of that with some pretty darn good premium going down to zero. But
yeah, you guys have had range plus volatility, as we were talking about right before we came on the air. So
yeah,
must be nice for you guys.
Yeah, you got to be nimble. It goes up to 18 or 20, but it certainly doesn't last. And so the bottom line is when you do get a spike, you have to have some conviction on what you're thinking, and then execute whatever you're doing.
Gotcha. All right, Steve, let's go to you next. Tell us a little bit about your trading, and tell us a little bit about OptionView.com. Steve Lentz, to you.
Thanks a lot. Steve Lentz here with Discover Options. Discover Options is the educational arm of OptionView Systems. Been in business since 1983 with high-end options analytics. Discover Options, we focus primarily on the one-on-one mentoring approach to learning options trading, and we have different levels. One is for option overlays, folks with long-only portfolios and want to have an option overlay, covered calls, puts and collars and all that. Level 2, we take people into directional spread trading, horizontal and vertical spreads, and then we also get into level 3, which would be the non-directional premium collection approach, which has done so well this year so far. And also we get into futures as well. And I manage the mentors, professional traders mentoring on the side. They're managing money, and I produce the content, and we have a good time here.
Cool. A lot of moving parts with options. So you guys on the educational side, you got a lot to do. So that's good stuff there. All right, Todd. Let's go to you. Todd Gordon and I, we go way back in the day to a popular website over, I guess it's 15 years ago. Good Lord, we're getting old.
I know.
Anyway, I've known Todd forever. Todd Gordon of TradingAnalysis.com. For those of us who don't know you, Todd, tell us a little bit about your trading, and tell us a little bit about TradingAnalysis.com.
Sure.
Sorry.
Yeah, no problem. Thanks, Dave. Great to see you again as always. And hey, guys, looking forward to working with you today. So Trading Analysis is my research business. I've been in the business really since I started when I first met Dave, so that was about 15 years ago. And we do heavily focus on the option side. I take a little bit more in-depth approach to the technical end. We get a little bit more advanced with our models. So we tend to trade more spreads, credit and debit spreads on a directional basis. So it's been a little difficult for us. We are premium sellers, but we like to do it when there's a move kind of forthcoming. So it's been a little quiet this year. We've definitely been active, but it's amazing how range-bound the market's been. So, so that's kind of our approach. I do a weekly show on CNBC. You guys may have seen me there. I bring the technicals to CNBC, and believe it or not, they love it. A technical approach. So that's us. Yeah, we do focus on trade alerts, education. I trade my accounts live, send out the alerts to clients, and just like the other gentleman on the line, we love what we do and have a good time doing it.
Cool. For those of you who don't know me, my name's Dave Landry of DaveLandry.com. I'm not quite nearly as advanced as these other three guys here. I keep things more simple. My nickname, and I've got to stop saying this, but my nickname is the trend following moron. I believe you can't really draw a big blue arrow on the charts, then you really don't. Then you should be trading the trend. And right now, obviously, the trend is sideways. We might elaborate on that in a few minutes, I should say. I think you can only predict the short term when it comes to markets. I trade reversion to the mean in the direction of the trend, and that's a fancy way of saying pullbacks. I'm looking for a bounce from oversold in strongly trending markets, or a bounce from a bit of a pullback in an emerging type of trend. I have a 21-page report that you can get on my website. I think there's a banner ad up today on that, and it's free. So check that out. The rest of the methodology is just details, but that's pretty much the crux. You get that. You get the crux of the methodology. Very simple, straightforward, common sense type approach to the markets. I've like everyone here. I'm assuming I've tried a little bit of everything, and then I decided to just kind of boil it down and keep it as simple as possible. So that's where I'm coming from on that. Jim, you're up next.
Okay.
Based on any technical fundamental indicators you want to use, would you predict that S&P 500 will move higher or lower by Friday's close? And that's August 14th, Friday, August 14th. To you, Jim.
Okay. Basically, the fundamentals seem to be that there's consumer news coming out on Thursday, which obviously will have some effect on the market, retail sales. Since this market has been range bound, it is difficult, obviously, to say with any conviction. But the way the Russell looks today, where it had a low on Friday surrounded by higher lows, I'm going to go out on the limb and say it might be higher by Friday, and I'll go with about a 2 on that, 2 to 3.
2 to 3. So low confidence. Is that what you're saying?
Yeah, I mean, we're at the top of the trading range, so if it reverses tomorrow, because in my view the liquidity up here is so lousy, if anybody burps and everybody starts selling, it'll drop 20. It'll drop 20 points. So the bottom line is, until there's some liquidity up here, every move you look at has to be looked at with a suspicious eye. But I'm just saying the technical figuration on the Russell would lead me to believe that it looks like that might have made a low on Friday, and if that's the case, matriculating a little bit higher between now and the end of the week is certainly not off the board.
Yeah, I'm going to pull up that Russell in a few minutes. I think that's kind of an interesting thing, and it's interesting what you pointed out there. Steve, let's go to you next. Based on any technical fundamental indicators you want to use, would you predict that the S&P 500 index will move higher or lower this week? And that's Friday's close of the 14th. And once you give us your answer, rate your confidence to that on a scale of 0 to 10.
Yeah.
Well, actually, that's the old question. Let me see if he reworded it. Rate your confidence.
I got
by estimating the probability you have corrected. Okay. Let me just read the question. I'm so used to the other one. Rate your confidence in your answer to question 2 by estimating the probability you have correctly predicted next week's market move. So he changed the question up a little bit.
Okay.
So what probability do you think you can be correct? Sorry about that.
One thing I do every week is I do a weekly show where we cover several different types of technical analysis perspectives: linear, nonlinear, point and figure indicators, and we issue a report card, and I'll tell you, I've never seen so many indicators flashing neutral and non-decisive right now. It's just unbelievable, and you have to really start reading into you don't want to read in too much into it, but you really have to try and extract an argument to be made one way or the other. So whenever I've been on this show and I look at Monday's move, when we get together here, it's always penciled out that it ends up being the direction of that move. So since we're up today, I'm going to go with up for the week, and a confidence of 2 or 3. I could go through these. I mean, just from the Ichimoku approach, where it's all just sitting there, dead as a doornail. We'll get to things in a little bit. There's a further question I think we'll talk about a little bit.
Yeah, we're going to ask you details in 1 minute.
That's my answer. Yeah, that's my answer. It's
okay.
Non-committal right now, but I'll go with up with a confidence of 3.
Okay, cool. All right, Todd, you're up next. You know the routine. Basically, technical fundamental indicators you want to use, higher or lower by Friday, and then rate your confidence. And now we've changed that to a percentage.
Yeah, no problem. I'm actually going to go on a limb and say lower, with, again, a low confidence. It's important to keep in mind where we are. Don't beat your heads against the wall. We are right in the middle of summer doldrums. This is a light week for earnings. I think we only have, Cisco, I think we have Time Warner, and then there's one more on the block I can check. So earnings are low. We don't have any data until Thursday. We get a couple pieces of U.S. data Thursday, Friday. I think we have Chinese industrial production or something or other in the middle of the week. So that might be something, but it's a slow week. And as traders, I think it's important to remember that you're here to make money in opportunistic markets, but also it's your job to be very kind of comfortable with sitting on your hands. I went home short Friday, and I got a few little holes in me here this morning. I got stopped out of some positions this morning, so you took a shot to break the range. I knew there was a decent chance that the range wouldn't break. Came back, so I still think we want to drift lower. I think the markets are pricing in a September rate hike, at which time they would rally. But right now for this week, I'm going to say lower with the same thing, 20-30% chance of heading lower, really because there is no data. There is nothing really of any significance, and we're very range-bound, top of the range. The Russell is leading. I went home short the Russell. The Russell is much weaker than the S&P and the NASDAQ. So just remember, this is summer doldrums right here.
Yeah, amen to a lot of those things. In fact, I'm glad you gave me some fodder for later on. There's some things I want to dovetail in on. Cool. I'm going to go ahead and say higher, and there's nothing scientific about my analysis other than I'm just following the long-term trend, as everybody's pointed out today, and we were complaining about, well, you got option guys aren't complaining too much, but I've been complaining about is the market is stuck in a sideways range. So, but what I've been looking at, and I'll pull it up in just a few minutes, but I was looking at the just like the 200-day moving average, and so far we got a positive slope, and so far the S&P is above it. Not that that's a line in the sand, but there is some support around that area, about 2075 in the S&P, and then where it previously touched it around 2050 or so. If we break below those levels, I would begin to get concerned about the market as a trend follower. As long as we're at or near new highs, or not too far, I should say, from new highs, then I'm going to continue to err on the side of the longer-term trend instead of trying to outsmart the market, especially when it's range bound. So I'm going to give myself confidence of 6, just slightly above, I guess, halfway there. So, okay, let's go back to you, Jim. And the next question is, this is where we're going to elaborate a little bit on what we're seeing and what we think is going on. What developing events will you be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Well, again, like I said, we have some earnings. They were mentioned. I guess Alibaba and Kraft Heinz are another couple of companies that are going to be announcing. And then consumer retail sales on Thursday would be, something to look for. But I'm at a point where I'm looking at, say, a broad-based index like the S&P 500, and I'm looking at the VIX, the volatility measurement. And the VIX made a 52-week low last week at 1088. So obviously that's pretty low. And now it's in the 12s. So this S&P has a high 2135, something like that. If we blew that out, with some conviction and stuff, good breath, whatever, then I think we could start saying that maybe there's a move to 2240 coming. Conversely, if it rolls over from here because retail sales disappoint, we're back in the soup again. So this is a seesaw market. There's a lack of liquidity out there, so whatever they're currently doing, the market makers just exacerbate that move. And if there's no volume behind the move, it falls on its own weight, or it rises with no weight. So basically, I would look at the indexes to see if they can give you some confirmation. And I would say that Thursday's report on retail sales might be the match that lights the volatility fire.
Yeah, I would almost, and I guess Todd's going to shake his head with me, I would almost like to see some follow-through to the downside today, just to shake a few more people out before headed higher. It's like when it turns around at support or at moving averages like it did and everything, it makes it a little bit difficult. It didn't really fake out anyone just yet. Steve, let's go to you. Same question. What developing events, technical fundamental, will you be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Yeah, well, I think if you look at the S&Ps, we have a 1-month triangle that's been developing, congesting just since from the low of July up to today, with yesterday's low being a lower trend line, and when you compare it to other indicators going on, a breakout to the upside is not going to produce the case for the bulls as much as a breakout of that triangle to the downside. If you flip over and look at a point and figure chart, that would be if it does flip down and go down to say 2060, you're looking at a triple bottom breakout with declining highs, which would be a pretty, and it would also at that point I think go through the 200-day average. That would be a pretty strong case for a longer-term bearish position at that point. That would be a pretty nasty technical signal at that point. But if it breaks out to the upside, it could turn out to be a continuation and it just stays in the range. Maybe it'll go up and retest at 2130, something like that. But I'm just waiting to see what it does within this triangle.
Okay, cool. All right, Todd, let's go over to you. What developing events, technical fundamental, will you be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Yeah, we mentioned it already. The earnings I think are pretty light. We have Cisco, Hines, as we just mentioned. Let me just take a look what else is important. Rackspace, take it or leave it. Looks like we have Macy's, a little bit of retail there right before retail sales on Thursday, Cisco on Wednesday. Altera, okay, JCPenney. So we have some retail earnings coming out, retail. So that, that's fine. I don't think this is a week to be really focused on. I know we're doing the show week by week. I think it's a kind of play pretty close to the vest. One point that I wanted to make, though, it kind of ties into this question as well as the last one, and Dave, you just mentioned it. We're all complaining about the sideways nature of this market, and an indicator I like to look at in terms of volatility is ATR, average true range. I think it's a great indicator, and it does really the same thing as implied volatility. I'm looking at the ATR on the SPX. Right now it's 19 per day, right? So we're getting on average 19 travel points per day, high to low in the S&P, which is pretty good in the context of a 2015 market that's gone nowhere. You compare that back to looks like June, July, and August of last year, you had an ATR that was like 12, 13, 14, 15. So, we're still getting some volatility here. There is tradable movement in here. So before we, and I'm guilty myself, I'm kind of reminding myself, before we just bash the summer doldrums, there's more movement here than there was a year ago. So I think the market is very much positioned for a big move. I'm getting very cute here, trying to pick up pennies for the steamroller chart. To your point, Dave, kind of shake out some longs before we go up. And I think 2160 to 2200 is where we trade coming into September. And I think they'll probably buy it on the Fed rate hike. So I do think it goes higher. Completely separate conversation. Once we get up to 2200, technical models that I follow, that's where a major decision is going to be made. So shorter in the near term, higher in the long term. 2200 is a major decision point.
All right, gotcha. Okay, I'm sharing my screen here. I was talking earlier about the moving average, and one thing that I like to point out and often point out in the shows is, first of all, everything works better with trends. So when the market is trending, even the simplest of methods work really well. And I'll see people will show a chart that goes, like from here all the way to here, and they'll have 100 buy and sell signals throughout. And I'm like, well, if you just bought it across the moving average and held on to it, you'd have one or two buy and sells, and you'd caught the whole trend. But that's only when the market is trending. Obviously, if you just trade moving averages, they can chew you up. So they can help to keep you on the right side of the market. By the way, to answer the question, I'm a purely technical trader, so I only look at the charts. When you make a trade, you're not agreeing on the fundamentals or the situation in Nigeria or what's going on in Greece. You're agreeing on price and price only. So that's why I focus on the price, and I ignore all news. But the daylight concept I was talking about is simply when you have lows greater than the moving average, or on the downside, you have the highs less than the moving average. And so far, we're doing okay with the S&P 500. We just kind of came down and kissed it again, which is also towards the bottom of the range. A lot of times technicals come together at the same point. Russell came up earlier today. I think Jim mentioned it, and I think Steve might have mentioned it too. Russell is a little bit more indicative of what's been happening in this market. As you can see, it's headed down from the peak made back in June down to where we are now. And we were below the moving average, had 1 day of daylight, and now we're back up to the moving average today. So far, you can see positive slope in that 200. Again, nothing magical about the 200 or any moving average or any indicator for that matter. I tend to just look at charts. without any indicators. But when the market gets a little iffy like this, I like to throw a 200-day moving average in. I also have what I call my bow tie moving averages, which are a 10 simple, a 20 exponential, and a 30 exponential. Not enough time to get into that today, but I have plenty of YouTubes on that. So if you go to my channel and search for bow ties, you get some information on that. And so that's something that you want to pay attention to when the market does get a little iffy. But so far, Russell bouncing a little bit in here. But if you look internally, the action has been a little ugly. But for the most part, I think when the market remains in a long trend like this, you want to err on the side of the longer-term trend. But it doesn't mean that you don't want to be selective. I haven't had a trade in a while, and I had a setup here too, but none of them triggered. And like Todd alluded to, or actually flat out said, sometimes you just have to wait. And I think that's, like Tom Petty said, the waiting is the hardest part, especially for the more novice traders. I think as you get better and better at this game, you find yourself wanting to trade less and less, and only when the opportunities present themselves. So if you walk away with anything today, just realize that you want to trade when conditions are conducive to your methodology. And like I said earlier, everything works better with trend. Let's go back to you, Jim. Question of the week, and I decided before the show I said I was going to dodge it, so we were able to. You could talk about anything else you want to, or the second question will be how long will this market stay in this range? But the official question is, did you watch the first Republican presidential debate? Do you think any of the candidates would make a particularly good or a particularly bad president for the development of U.S. markets and economy? Or you could say how long the market will be in the range, or anything else you want to talk about.
Well, these are just my opinions, but my view, similar to Todd, was that the 2200 to 2240 area, which would be a 40% jump above the highs of 08 and 2000, would probably be a huge area of decision. And the decision's probably going to have to come from, obviously, are the comparative earnings going to keep up, and who's the next guy to take out? Who's the next guy to take over? After watching the debates, I think there's plenty of reason to worry about who's going to be taking over next. So that part of the issue, I think we resolved at the meeting. Plenty of reason to worry if they're the next guys in town.
Pick the dog with the least fleas. Excuse me. Pick the dog with the least fleas.
Yeah, that would be about it. Or who's going to be there to keep organized when Rome goes on fire. Because, again, as we get further into this thing, I mean, anybody from third grade can see that we've had a very, very long run on that chart from 2012. Yeah. And obviously that takes a lot of gasoline to go up there, and the gasoline might get a little thin as you start comparing earnings and top-line growth year over year after these numbers have already expanded dramatically. In fact, I think we've even started to see top-line growth look a little weird. You can buy back stock and you can do other kind of things to make your earnings look better, but obviously you can't run away from top-line growth. It is what it is. Gotcha. So at any rate, I think right now, as those moving averages which we're saying, right around 2,000 on the S&P, as long as we stay above that, neutral to higher is the way to go. And if we were to break under 2,000 and stay under there for any length of time, then it would be setting up a scenario where an 08 type situation, the probabilities would be increasing from that point. But basically, that's what I was seeing as far as the overall market is concerned.
That's I like what you said about get below the range and stay there, and that's something that I wrote a little bit about today in my column. The thing is, if you dip below a range and you come right back in, it's a bit of a fake out for the traders and all, but the people who are holding longer term, sometimes they don't even notice it. But if the market drops below a big range, and this is not for your benefit, obviously, Jim, but for everyone else, when the market begins to try to rise back above it, once those prices, people get used to those prices at a certain level, then that becomes overhead supply, and people looking to get out of break even. It's just flat out human nature, and there's nothing magical about that type of technical analysis at all. So it's interesting that you said if we stay below that range. Go ahead.
Yeah, one quick thing on moving averages. My view, and my opinion, is the direction of the moving average is just as important as the average. So if you notice in 2011 and in 2014, I guess during that October drop, it stayed down a very short period of time, and the moving average never went down. And so obviously a month or two of penetration, if the average is not pointing down, is not problematic in my view. One quick thing on the interest rates, I'm not going to think that this hiking of rates is going to have any significance until we see the 10-year note trade above 260 and then 3%. When you get above 260 and 3% yields on the 10-year note, then I'll be more of a believer that words will turn into action, because there's a lot of people who blew out utilities and junk bonds and things like that, and they could be dead but wrong if this interest rate hike, as they say, is just a muted nominal situation.
Yeah, it's like we had that shot across the bow a few months ago, and it's like you got to find something else to worry about now, and it's the delta rates that's concerning, and it's not the absolute level. I'm sure everybody here remembers when we had pretty good markets when the interest rates were 8%. So it's the change that gets everybody spooked. Steve, let's go over to you. It is kind of an open question if you want to make it that way. Did you watch the Republican presidential debate? Do you think any of the candidates would make a particularly good or particularly bad president of the development of U.S. markets and economy?
Well, I'll go ahead. I'm in politics a little bit. I'm in the municipal politics here in my town of 30,000 people, and so I do watch this stuff. I'll just make a few observations. I don't know that it'll just a few observations here. I think I was watching a biography of Teddy Roosevelt, and they said that he was one that liked to be the bride at every wedding and the corpse at every funeral. He would just walk into a room and dominate the place, and I don't think we've seen anyone since then except for Donald Trump coming around, and people are responding to it. I have a 19-year-old son. He's not into politics, so he comes home one day and says, "Dad, what do you think of Donald Trump?" I said, "Why are you asking me? I mean, he doesn't he doesn't follow any of this stuff." And I said, "Why?" Because, well, me and my friends were talking about him, and I said, "Well, this is interesting. Would never have thought." But I just bring that up just because I think there's something there. I don't know that he'll be good or bad. It's tough. You just don't know about his motives, but I do know that I believe that we haven't seen anyone like him since Teddy Roosevelt, and he is capturing the imagination. He's someone to watch. Also, I was at the movies last night at Mission Impossible, and the the previews for this Benghazi movie came on, and it's a Michael Bay movie on Benghazi, and it's not going to help Hillary. So I don't know. That's just a little bit of tidbits thrown out there. I'll go to the range thing and talk about that a little bit. Looking at the markets, if you go to a monthly chart, you'd have to go back to 05, 04 to see a period of time where we have been in this range for so long like this. And in those cases, it resulted in a breakout to the upside after a pretty big move up to the upside in 03. So I just make that observation looking at this. It's unusual. I don't know how long it will go, but it has. You'd have to go back to 04. It has gone a few months longer in previous years. You have to go back 10, 11, 12 years to find that. It definitely is unusual. Tough to say, though. I wouldn't want to predict.
Yeah. No, I hear you. No, I'm not going to have much to say on the debate because I didn't watch it, and I'm not. I ignore all news for the most part, except when Todd's on CNBC. But he's got to send me an email when you're on so I can turn it on there. Todd.
Thanks, buddy. Appreciate it. I just talk technicals anyway, so.
Yeah, I like what I like what you said about Trump. Like him or not, he's just out there speaking his mind, and nobody's had the guts to do that in a long, long time. So I think that's kind of interesting. Todd, same question to you. Did you watch Republican presidential debate? Easy for me to say.
Yeah.
Do you think any of the candidates would make a particularly good, particularly bad president for the development of U.S. markets and economy?
Yeah, that's. I agree. That was Jim. Jim made the point just now about first since Teddy Roosevelt.
I think it was that Steve?
No, that was Steve.
That was Steve.
Steve, sorry about that, Steve. I actually read that same thing. I thought that was interesting. I don't know. It's kind of tough. How could I not? Actually, Trump, believe it or not, was at my wedding. He was at my wedding reception. So he was a gentleman. I know him, and he's a gentleman. He really is. But in terms of shaking it up, trying to break status quo, I think, my personal opinion, I think this era of professional politicians needs to come to an end and get somebody in there who knows how to actually run a business. So whether it's Trump, whether it's not, I don't know. I think if anything, somebody's going to come in and start to talk tough on the Fed. And I understand the government and the Fed are supposed to be separate, but if anything, I think we're way overdue in terms of of increasing interest rates, really winding down this bond position. The Fed can talk tough about this first quarter point hike with stock market at all-time highs. What's going to really happen if we get a real bout of volatility in here? You think they're going to raise rates? I mean, we could be stuck in this for a long period of time, but the rest of the world still full on quantitative, still on foot on the pedal, flooding the system with liquidity. So I say
taking a page out of our book, huh?
A hell of a, let's shake it up, man. Let's do it.
Yeah.
We can't even raise a quarter point with stocks at all-time highs. Are you kidding me?
Yeah.
It's crazy. But anyways, I think it's more about I'm just watching the 30s, the 10s, and the 2s here, and what's happening right now is we're getting a flattening of the yield curve. You get, 30-year bonds have been rallying pretty sharply. They're off today, 156, 29, 30 seconds. So you're getting a flattening of the yield curve. That's going to start to back off prices. I'm looking at the sector performance here. Financials have been done well here a little bit. But if you keep getting these longer dated bonds rallying, that yield curve flattens, and that a yield curve that goes like this, the flattening, that eventually leads to an inverted yield curve, and that's what eventually tops out the market. So I think we're a ways from that. We're just starting to see the beginning of that. Looking at the sector performance, and this just goes back to our analysis that I do think stocks go higher, particularly when we raise rates. I think they're just selling off in anticipation of that. Look at it, Dave, the NDX, NASDAQ 100, I got the 200-day simple and exponential at 43.42. We're trading 45.16. We are a long ways away from the 200-day moving average. So technology is doing fine. The 1-month sector SPDR, technology leading. On the 1-month percent change, on the 3-month, it's right there. Technology is coming on. Consumer discretionary continues to be strong. Healthcare taking a bit of a beating lately, but you got healthcare, consumer discretionary up there, technology starting to rejoin. NASDAQ's considerably above the 200-day. I mean, you just got to go higher. You just got to stick with your trend to your point. But in terms of the debates, I don't know. Why not? It'd be entertaining if anything. Shake it up, and I just get through the summer in terms of low volatility. But I do think we're going to reach for higher levels.
Okay. As far as the debates, I didn't watch them, but I did find it kind of interesting. I went in the house for breakfast the next morning, and I didn't know there was debates the night before. But anyway, my wife had the Today Show on or whatever, and they were interviewing these candidates. And every candidate that came up, they didn't ask him about his policies, about what he thought about anything. It was all about Trump, and every person they asked him about Trump. So. That's kind of interesting. I don't know if he's electable, but at least he's out there, like I said a minute ago, just speaking his mind, like him or not. As far as who gets elected, I don't think the market really cares, believe it or not. It's been years since I looked at any of this, but I think there have been studies that suggest that the market actually goes higher with the Democrats in charge, which is just the opposite of what you would think. Because the Republicans seem to be notorious for being pro-business, or at least they claim that. So I don't think it matters. I think, was it Steve? Were you talking about the monthly range, or was it Jim a second ago?
Yes, I did. Yes.
Okay, let me just, since you can't share your charts easily, let me just pull up a monthly chart and show something real quick. So this is a monthly chart going back a few years. And you can see this little range we've been in here. It's kind of minuscule when you think about it in the big scheme of things. So maybe the market is just resting a little bit before it goes higher. But obviously we need to pay attention to the range-bound nature of the market. But every now and then it helps to kind of back the chart way out and gain a little perspective, kind of like Todd was alluding to a few of these things about that we might not be done yet. And as a trend follower, I have stops in place. If I get stopped out, I get stopped out. If I have to start shorting, I'll start shorting, but I'm not going to worry too much about all these news events and everything else. I'll let everybody else worry about that. People actually sometimes get mad at me because I'm not passionate about these things, but I have enough to worry about, like the rest of you guys, I'm sure, too. So, anyway, let's go to you, Jim.
You got to trade with your personality. That's the most important thing with trading. You've got to find there's so many different ways to skin this game, skin this cat, play this game. You got to work with something that agrees with your personality and who you are, because that's the only thing that can last in the heat of battle. So don't apologize for that.
Yeah,
that's a great point.
Good point. Okay, Jim, let's go to you. Any closing thoughts? Anything you want to say? Floor is yours, or anything closing thoughts you want to tell us about OptionProfessor.com?
Well, I'd like to just give you just a little around the horn type thing here. A lot of people are interested in stocks and other stuff as well. The U.S. dollar seems to be in a high level consolidation, and it's still pretty strong at the 97 area, and the moving averages are catching up to the price. So that trend may even get a bounce to the upside if it if it gets some decent news. Oil, they're having party hats on because it went from 43 to 44 today. I didn't when I read the headline, stocks up big on oil jump. That jump's about as good as I jump nowadays. You know what I mean? So anyway,
I thought it was bad for the market.
Yeah. And then a couple things that I'm looking at peripheral here. The Chinese stock market went up to like 51, 5,200. Had a very big tank down to 3,500. Today it's up about 5% at about 3,900. That's still about 25% off the high. Yeah. And if it can't get much above 4,200 here and rolls back down, there's a better than even chance that 5,100 might be the high of this cycle. And the transportation average hit a high back in November, December at about 9,300. We haven't seen 9,300 obviously now in a long time. So if those two things have actually peaked, it wouldn't be surprising to me that if we are in some kind of a final distribution phase, it could be a rally to 2240, but what's that, 5% move? Nothing. So the bottom line is from look at that chart, it looks to me like people wouldn't be unwise to know how to do married puts or some kind of collar strategies so that if things start rolling over, because there are some stocks that have rolled over a bit. Your Procter & Gamble has an inverted 50 and 200. Walmart has an inverted 50 and 200. And, of course, Exxon does. And so, it wouldn't be unwise. I had a buddy of mine who had bought a stock for 3 and it went up to like 11, and he wanted to do covered call writing. I go, the calls are going for 10 cents. What are you selling all the rights on your stock for 10 cents? Why don't you just give the guy the stock, So the bottom line is, what about buying a put on it? You got 8 points in the stock. Why not put, a half a point into insurance? You'll add a little bit to your cost basis, but if the thing falls apart, which it has done coincidentally, it would be helpful to know how to do that. So
let me guess, you didn't listen to your advice.
Yeah, at Option Professor, you learn all the different strategies, and then you start using some common sense and talk to your advisors and whoever else you go through, clearing firms, and find out what might be suitable for you or not. And then, but at least, some of these more defensive strategies in the next 6, 12, 18 months might be the ones to know about.
Okay, cool. All right, Steve Lentz, floor is yours. Anything you want to tell us about the markets, the trading, Donald Trump, this range, or OptionView.com?
Well, thanks, Dave. Just want to remind, if folks don't already know, with options, you don't have to necessarily predict the direction. You could just trade in a way where you would make money whether it goes up or goes down, and you don't get caught up in all the market noise day to day, even week to week. And so that's the beauty of options. And for us, that would be the level 3, but there's definite strategies, and it enables folks that maybe you're looking at this and thinking, well, technical analysis and fundamental analysis, it's just one big game of Twister, and I'd rather not get involved in that. And there are strategies that enable you to basically put those aside and focus on volatility and the strategies, and that's something that we specialize in, and I know a lot of people do, and we've been at it for a long, long time with some of the best tools. So anyway, if you're interested at all, you can visit us at OptionView with the VUE, OptionView.com, or DiscoverOptions.com.
Cool. All right, Todd, closing thoughts from you, or anything else you want to tell us, or anything you want to tell us about TradingAnalysis.com? To you.
No. It was a pleasure to be with all you guys, Jim and Steve and Dave. You guys are awesome. I tend to find that the most kind of profit potential lies in trending markets. We're in a range-bound market here. If you are premium sellers and other kind of low volatility strategies, just be careful. The risk rewards tend to get a little skewed in low volatility markets. I do think there's a lot of volatility coming. To be in the trading business right now is excellent. I think we're going to see a major shift out of this investment mindset to the trading mindset. So this is a great business to be in right now. We are, I think, on the verge of a major volatility spike in coming months, and I'm very bullish about the outlook of our business and in the trading markets. The tools that are available to all of us are wonderful as retail traders. So I'm excited. Life's good, and yeah, come check us out. TradingAnalysis.com. We again, we provide research, we provide analysis. We can get about 1 to 2 trades a day. We send them out in SMS alerts, and you'll find us a little bit more heavily geared towards the technical end, trying to identify the best setups in each individual market. So we'll leave it there, and thanks again for having us.
Cool.
I appreciate it.
Cool. Thanks for coming, Todd. Dave, my website is davelandry.com. davelandry.com is my email if you want to email me anything. I do a weekly webinar, Dave Landry's The Week in Charts, and we have a lot of fun with that. We don't take ourselves too seriously in those. Bring your trading questions and your favorite stock picks. We'll take a look at the markets. I'll lecture a little bit on what's happening as far as if there's any lessons to be learned, discretionary techniques or anything like that. I don't know if I mentioned it earlier, but I do. When it comes to predicting the markets, as I said, you can only predict the short term, but you can stick around as long as the trend moves in your favor. Longer term trend following is too risky, and the drawdowns are just abysmal, and your accuracy is very low. Shorter term is a little bit better, but you simply don't make enough money. And if you take a hybrid approach by combining the two, I think that's the best approach. Again, like Todd said earlier, you have to find what sort of fits your personality, makes the most sense to you. You can't trade somebody else's methodology if it doesn't make sense to you. But I do keep it simple. I do the weekly webinars, and I answer all my emails. So check out my website, get a couple of free reports. You can get started cheaply. Like Todd, I do have an alerts type of program out there, so if you're interested in that, let me know, where I actually will pick the stocks, and there's no guesswork involved, where to enter, where to take partial profits, and how to trail the stop. I do all the legwork for you, and some clients use me as part of their staff, and that's great. That's fine with me. Anyway, I think that's it. I want to thank everybody for being here. Todd, Jim, Steve, appreciate you guys coming today to the show. It was good to have some veterans back on the show. I think this was a really good show. Let me turn it back over to you, David Kosmitter. Thank you so much, and thanks to Timing Research for having me back once again.
Yeah, thanks, guys. Great show. Just want to remind everyone who's watching, you can go to TimingResearch.com/reports and download this or any past report there. Also, next weekend, be sure to go to TimingResearch.com/current survey and fill out the next survey before the report comes out Sunday evening. And I just want to thank my guests again, Todd Gordon of TradingAnalysis.com, Jim Kenney of OptionProfessor.com, Steve Lentz of OptionView.com. Thanks, guys, for being on again. And, of course, Dave Landry of DaveLandry.com. Thanks for hosting again.
Thank you.
Thanks, guys.
Okay, thanks a lot, you guys. We'll see you soon.
Take care.